if you've been trying to follow the Federal Reserve lately or just, keeping an eye on the economy, you're probably feeling that whiplash, those conflicting
Oh,
signals.
definitely.
One minute things sound pretty solid, the next uh, recession talk is everywhere. It really is like walking a financial tightrope, isn't it?
Yeah,
Trying to figure out the next step when everything feels so unpredictable.
that's a great way to put it. We're really in a time where uncertainty isn't just some buzzword. Uh it's almost the main theme in finance right now.
Right.
And it means everyone, from the Fed down to individual consumers, is trying to navigate this really complex environment.
Absolutely. And that complexity, that's actually our mission today. We're going to take a deep dive into the Fed's latest meeting minutes, unpack some of the very public pressures on its leaders,
Mm-hmm.
look at that weird disconnect between how people feel about the economy versus the actual data, and then see what experts are predicting for interest rates, say, over the next few years.
Yeah, try and make some sense of it.
Exactly. We want to give you a clearer picture of why uncertainty is the word of the moment and, what it means for your wallet.
And to do that, we've gathered insights from, well, quite a few places. We've got stuff straight from the Federal Open Market Committee's June meeting minutes. That was June 17th, 18th.
Okay.
Plus analyses from financial news like Benzinga, Forbes, commentary from advisors at HBKS Wealth Advisors, even a historical look at political pressure on the Fed from Econofact.
Oh, interesting.
Yeah, and we'll check some future rate predictions from Narada Real Estate Investments, too.
Great. So let's kick off with where the Fed actually stands right now,
Mm,
which, as you said, seems to be firmly in that uncertain zone.
that's right.
The FOMC, that's the Fed's main policy group, they met last month, June 17th and 18th, and decided unanimously to hold the federal funds rate steady.
Yeah, no change. It stays in that 4.25% to 4.5% range.
Okay. And you mentioned something really jumped out from those minutes.
Well, yeah, the word uncertainty has showed up. Get this.
Yeah.
28 times in the minutes.
28 times. Seriously.
Yeah. And Fed Chair Jerome Powell himself apparently used it 19 times during the meeting. That's according to Ed Yardeni's analysis.
Wow. 19 times from Powell alone.
Yeah,
So that's more than just a theme. It sounds like their core operating principle right now.
it really does.
What does that tell us? That much emphasis on uncertainty. And how does it lead to this wait-and-see approach they seem to be taking?
It tells us they're being incredibly cautious. Like,
Man.
extremely cautious. This whole wait and see thing is largely driven by what some are calling Trump's tariff turmoil. All the trade disputes and new tariffs.
Right.
There's a genuine concern these tariffs could still push inflation up, even while the economy itself just sort of continues to trudge along, as one source put it.
Okay, trudging along. But what if that trudge, slows down even more? Did the
Yeah.
minutes mention anything worse, like stagflation?
They did, yeah. FOMC members explicitly talked about the risks of stagflation. That's that really nasty mix of slowing growth and inflation that just won't go away. They're worried about that possibility if inflation stays stubborn while the job market starts to weaken. They also pointed out that, lower and middle income families could get hit hardest by price hikes from tariffs.
Because they're already stretched thin.
Exactly. Already switching to cheaper options.
Now, the Fed staff apparently think rate cuts are coming this year, 2025. But the minutes showed the actual voting members, the FOMC, are kind of divided.
Oh, definitely divided. It said most staff see cuts this year, but among the members, a couple were open to cutting rates maybe as soon as July.
Okay.
But then others, it seems, saw no reductions at all for 2025. They're pointing to inflation still being above target and the job market holding up surprisingly well.
That's quite a split. It really shows the balancing act they're facing.
Absolutely. That internal division is a huge sign of just how murky the waters are, even for them.
And speaking of murky waters, those tariffs. The Trump tariff turmoil isn't just some phrase in the minutes, is it? President Trump has been really vocal.
Extremely vocal. Yeah, he's been demanding, I think it was a 3 percentage point rate cut, saying Powell is too late and it's costing the U.S. billions, like $360 billion per point per year in refinancing.
Wow. And he's called for Powell to resign too, right? Multiple times.
Yes, multiple times. And it's not just talk. Just the day before those Fed minutes came out, July 9th, Trump slapped 50% tariffs on Brazil.
50%.
Yeah, and sent letters to Japan, South Korea, others, basically giving them an August 1st deadline for new trade deals.
Yeah.
So tensions are definitely escalating.
How does the Fed view these tariffs in terms of inflation?
Well, most central bankers, according to the sources, think these tariffs could have more persistent effects on inflation, which could force them into, tighter monetary policy for longer.
Right.
The IMF, the International Monetary Fund, they've also warned Trump's policies could put inflation higher. And while inflation has come down from its peaks,
Yeah.
the main measure, the PCE price index, was still 2.3% in May, and core was 2.6%, both still above that 2% target the Fed wants.
So inflation's sticky. It just doesn't want to go back in the box. What are economists thinking now?
Well, Jeffrey Roach at LPL Financial actually expects the next inflation report, the one coming out next week, to show things heating up again slightly.
Oh, really?
Yeah, which he says gives the Fed more reason to keep rates elevated. He doesn't see much improvement until later in the year. And Fed staff themselves, their median forecast sees inflation climbing back up from 2.7% to maybe 3.1% by December.
Oof. Okay. And is it clear how these tariffs actually translate into prices we pay? Is it like tariff goes on, price goes up immediately?
No, not at all. It's way more complicated. There's a lot of uncertainty. There's that word again about the timing, the size, even how long the effects last.
Right.
Some think it might take a while for prices on shelves to rise, as companies use up inventory they already have. Others think maybe the impact will be limited if trade deals get worked out or companies shift suppliers quickly. But several Fed participants noted that even companies not directly hit by tariffs might raise their prices too, sort of taking advantage. And the impact could be worse for smaller businesses or ones with really thin profit margins.
So it's a ripple effect, but nobody's quite sure how big the ripples will be or where they'll end up.
Exactly. It makes the Fed's job incredibly difficult. It's like a high-stakes guessing game based on policy, business reactions, consumer behavior, not just straightforward data.
That complexity really leads us perfectly into this other puzzle. The difference between how people feel about the economy and what the numbers are actually saying. Brian Summers at HBKS Wealth Advisors calls it the great divergence.
Yeah, it's fascinating. You look at the soft data, things like surveys, consumer sentiment, and it looks pretty gloomy.
People are pessimistic.
Increasingly so, yeah. Mostly worried about government policies, potential inflation.
So,
It suggests people might start cutting back on spending.
okay, so that's the feeling. But then the hard data, the actual economic reports.
Tell a very different story, at least for now. Like, yes, the economy shrank slightly by 0.3% in the first quarter of 2025.
Which sounds bad.
It does, but Summers pointed out it wasn't necessarily a recession sign. It was mostly because imports surged as businesses rushed orders to get ahead of tariffs. And the Atlanta Fed's GDP Now model, it's now forecasting a pretty solid rebound, like 2.4% growth for the second quarter.
So, a bounce back. What else does the hard data show?
Well, real wages adjusted for inflation are actually near a 5-year high because inflation has dropped significantly since 2022. And consumer spending, it keeps going up despite the bad vibes in the sentiment surveys.
And jobs.
Still solid. Unemployment was low at 4.2% in May. Job creation is still healthy, actually beating expectations recently.
So people feel pessimistic, but they're still spending. Wages are okay. Jobs are being created. How does that work? What does this divergence mean?
Well, one measure, the Economic Policy Uncertainty Index, it's spiked. It's as high as it was during the peak of the pandemic uncertainty. And that uncertainty itself is like a drag on the economy. It makes businesses and consumers hesitant to make big commitments, buying a house, investing in equipment. And it stems directly from, the tariff policies, potential changes at the Fed, questions about government spending.
So the uncertainty itself is a problem.
Exactly. It's the core issue. This great divergence isn't just some academic point. It's the tightrope the Fed is walking.
Yeah.
They have a public feeling pessimistic while the underlying economic engine still seems resilient. The real danger. That negative feeling could become a self-fulfilling prophecy.
Right. If everyone pulls back because they're worried.
Then the hard data could start to reflect that worry. Summers thinks a recession is still unlikely based on current hard data, especially with consumer spending so strong that's 2/3 of the economy.
Right.
But he acknowledges if this uncertainty keeps up, that soft data, the pessimism, could start showing up in the hard numbers, maybe weakening things in the second half of 2025.
Which brings us to another key part of this whole picture. The Federal Reserve's independence. How it's supposed to operate outside politics.
Yeah, it's designed that way. It's an independent government agency, doesn't get funding from Congress, and the Board of Governors, they get these long 14-year terms specifically to insulate them from election cycles.
But design is one thing, reality is another. Presidents can try to influence them.
Right.
Directly or indirectly.
Oh, absolutely. Directly through meetings, telling cabinet members what to push for, or indirectly, through public criticism, speeches, interviews, social media these days.
Is there a historical precedent for this kind of pressure actually working or having an effect?
There is, and it's actually quite a stark warning. The Nixon presidency is the classic example.
Excellent.
Yeah. Researchers looked at the Nixon tapes and found clear evidence he pressured Arthur Burns, who was Fed chair back then, to pursue easy money policies right before the 1972 election.
To boost the economy for the election.
Exactly. Burns even wrote in his diary about feeling pressured to help Nixon's re-election, and many believe that political pressure was a major factor contributing to the high inflation the U.S. suffered through in the 1970s.
Wow. That context about meetings is striking, too. Clinton met Fed officials 6 times in 8 years. Nixon met them 160 times in 6 years.
Yeah, an incredible difference. It really highlights the potential for influence.
And we see echoes of this kind of public pressure today.
We do. President Trump has consistently criticized the Fed publicly. Some studies even found his tweets actually moved market expectations about rates. And back in January 2025, he specifically pledged he would demand that interest rates drop immediately.
And Powell's term as chair is ending next May, right? So Trump will get to pick a successor if he's in office.
Correct. Prediction markets are already handicapping the potential nominees. Kevin Warsh, a former Fed governor, seems to be leading slightly. Then Kevin Hassett from the National Economic Council, Christopher Waller, who's currently a Fed governor, and Treasury Secretary Scott Bessent. Those are the top names being floated.
But it's not just pressure from one side, is it? Didn't Senator Warren also weigh in?
That's a key point, yes. Back in February 2025, Senator Elizabeth Warren also urged Powell, but in the other direction for policy, actually for the same direction. She urged him to move more rapidly to bring down interest rates.
So pressure from both sides of the political spectrum, potentially. How has Powell himself handled all this?
From all accounts, Chair Powell has really appeared committed to steer clear of interference. He constantly emphasizes the Fed's independence and the need for it. He seems very aware of those historical lessons.
And what do those lessons ultimately tell us? What's the risk if the Fed does bend to political pressure?
Well, history strongly suggests that if the Fed caves to political pressure from either side of the political spectrum, it does not bode well for U.S. inflation. Plain and simple.
That independence is crucial for stable prices long term.
Absolutely critical. It's about credibility. The moment markets think the Fed is making decisions for political reasons, not economic ones, that's a problem.
Okay, so given all this uncertainty, the tariff situation, the political pressures, let's get to the crystal ball gazing. What are experts actually predicting for interest rates going forward, say through 2025, 2026, 2027?
Right. The bottom line question. Well, the general consensus among experts seems to be a gradual decrease in rates over the next 3 years.
A decrease, okay.
Yeah, moving down from the current 4.25%, 4.52% range, maybe settling somewhere between, say, 2.25% and 3.1% by the middle of 2027.
What's driving that expected drop, if inflation is still a worry?
It's mostly the expectation that inflation will eventually cool down more definitively, but it's a mix of things.
Like what?
Well, inflation's path is number one, obviously. The Fed wants 2%. Tariffs are a wild card there. Then economic growth is expected to slow a bit, maybe GDP growth around 1.5% in 2026. Unemployment might tick up slightly, maybe 4.4% in 2025. Slower growth usually encourages rate cuts. Government policies are a factor too, not just tariffs, but maybe tax changes, spending plans, and then global trends. Other big central banks, like the European Central Bank, Bank of England, they're also expected to cut rates, which can put some downward pressure on U.S. rates, too.
Okay, let's talk specifics. Numbers people can kind of latch onto. What about the Fed funds rate itself? Where do the forecasts see it ending up each year?
Okay, so the median forecasts, these are general ranges, obviously, but they suggest year-end rates around 3.50% to 3.9% for 2025.
Which implies maybe a couple more small cuts this year, like 0.25% each.
That seems to be the implication, yeah. Then for 2026, the range drops to maybe 2.50% to 3.4%, and by 2027, somewhere between 2.25% and 3.1%.
And what about longer-term rates that affect consumers more directly, like Treasury yields or mortgage rates?
Right. The 10-year Treasury yield, that benchmark rate, is expected to average maybe 3.5% to 4% in 2025. Then dip a bit lower in 26 and 27, maybe down towards 3% to 3.25%.
In mortgages, the big one for home buyers.
Yeah, the 30-year mortgage rate forecasts are wider, but generally trending down, maybe 6.2% to 6.8% sometime in 2025. Then potentially dipping into the 5% range in 2026, maybe even the 4% range, like 4.25% to 5.0% by 2027.
Okay, so translating that, what does this mean for your money for different people?
Okay, so if you're looking to buy a home, lower mortgage rates could eventually help with affordability. But, and this is a big but, high prices and just not enough houses for sale will likely still be major hurdles.
Right. Lower rate doesn't fix inventory.
Exactly. If you're borrowing for other things like a car, rates might edge down a bit, maybe from around 7.5% last year to near 7% this year. Credit card rates might ease slightly too, but they'll likely stay pretty high.
And for savers, people who've liked these higher rates on savings accounts.
Yeah, if you've enjoyed getting, say, 4% or 5% on your savings in 2025, those rates are likely to come down if the Fed cuts. Maybe more like 2.5% to 3% by 2027, swings and roundabouts.
And investors.
Generally, lower interest rates are seen as good for the stock market. It makes it cheaper for companies to borrow money for investment and expansion.
Okay, those are the predictions.
Yeah.
But you mentioned caveats before. These aren't set in stone, are they?
Not at all. Huge caveats. If inflation proves much stickier than expected, maybe because of those tariffs, or if the economy slows down much more sharply, or if there are big, unexpected shifts in government policy, or some global shock.
Any of those could change the picture.
Completely. Economic forecasting is tough, but forecasting in this level of uncertainty, it's extra tricky. These are just the most likely paths based on current info.
It's interesting, though, how the market sometimes just shrugs off the uncertainty.
Yeah.
You mentioned that on July 9th, the day after the Fed minutes stressed all this caution, stocks actually went up,
Yeah.
led by NVIDIA hitting $4 trillion.
Yeah, it's a great example of how markets can be complex. On any given day, really big company-specific news like NVIDIA's incredible run can overshadow the broader macro picture for certain indexes like the NASDAQ.
So the NASDAQ hits a record high, even as the Fed is talking uncertainty.
Right. It shows that investors were maybe more focused on the AI boom and NVIDIA's dominance than the Fed's cautious tone that particular day. Markets weigh different factors differently all the time. It doesn't mean the uncertainty isn't real, just that other forces can win out in the short term.
Well, we've definitely covered a lot of ground on this financial tightrope today. We've looked at the Fed's balancing act, trying to manage inflation and jobs.
While facing all these outside pressures, political pressure, tariff impacts.
Exactly. And hopefully untangling some of these forces helps understand why things feel so uncertain.
And it's not just academic, right? Understanding these bigger forces, it really does connect directly to things like your mortgage rate, how much you earn on savings, the overall health of the economy that affects your job, your spending.
It all connects back. So as we wrap up, knowing that this uncertainty is likely sticking around, as the quote said, for the rest of this year at least,
Yeah.
maybe our final thought for you, the listener, is this.
Yeah.
What proactive steps can you take to make your own financial decisions more resilient, knowing that predictability might be off the table for a while? How might this period of constant change, this flux, economic strength,